So let's review chapters 1, 2, 10, and 12. So starting off with just some basic stuff from chapters 1 and 2. We're going to be dealing with normal balances, right? So normal balances are how an account increases. So we have some accounts that increase with a debit, some accounts that increase with a credit, right? So your assets, drawings, and expenses all increase with a debit. So when we're dealing with journal entries, ledgers, knowing these normal balances will really be helpful. While your liabilities, capital, and revenue, those all increase with credits. Right? So knowing these normal balances will allow you to really work through any transactions, any journal entries that may be thrown at you. Then we also have our 4 financial statements I just want to quickly go over here. So your 4 financial statements that you need to know exist are your income statement, owner's equity statement, balance sheet, and statement of cash flows. Right? So you guys will learn about how to prepare a statement of cash flows later on in your class. But you just need to know right now how to prepare the first 3 and the order that they're prepared in. Right? So we first prepare an income statement because we then need the net income or net loss that we'll put on the owner's equity statement. Then the owner's equity statement will give us our ending owner's capital, and that goes on the balance sheet. And then for your statement of cash flows, you need a lot of different balances from the balance sheet. So knowing not only your 4 financial statements, but why they're prepared in this order will be helpful for you on your exam. All right, now let's get into the chapter 10 and 12 portion. So chapter 10, the big thing was depreciation, right? So you have a plant asset, and over time, that plant asset is going to lose value. The biggest example of this would be a car, right? When you buy a car, it will then immediately lose value the second that you drive it home, right? So any kind of asset, any kind of long-term asset like that is going to depreciate. So we have this example problem here that says Lincoln Company purchased a new machine on January 1st, 2019 at a cost of $150,000. The company estimated that the machine will have a salvage value of $12,000, and the new machine is expected to be used for 10,000 working hours during its 5-year life. So when we have that information in a paragraph like this, the best thing to do would be just to break it out with the key points, right? So the first piece of information that they give you is that this machine was purchased on January 1st, 2019. Knowing that date is going to allow us to know that for 2019's depreciation, it's going to be the full year. Because sometimes you might purchase a new machine halfway through a year, and then that's going to change the way that you're going to calculate your depreciation. The next piece of information that's important here is the cost. You're going to use this cost amount in every single depreciation method that we're going to solve for here later on in this problem. So knowing that you spent $150,000 on this machine when you first purchased it, that's going to be some important information. And then salvage value. What is this salvage value of $12,000? What does that mean?
Isn't that how much it's worth at the end of its useful life?
Right. So at the end of the life of this machine, we expect that we can receive $12,000 for it. Whether we sell it for parts, sell it for scrap metal, right? Whatever we're doing, we think that at the end of its life, we can get $12,000. So we use that because we're not going to want to depreciate past its salvage value. Now, the last sentence here, it tells us that the new machine is expected to be used for 10,000 working hours during its 5-year life. Both of those values deal with the life of this machine. Sometimes we care about the life of the machine in years. So that's going to be the 5-year life. Sometimes we care about the number of working hours. So this machine, we think it's going to stick around and work for 10,000 hours for us. Now, we can use all of that information to compute depreciation expense. So we need to figure out the depreciation expense for the 3 different methods that we learned about, right? So it's the straight line method. We need to figure out our depreciation expense under the straight line method for both 2019 and 2020. Then our units of activity method. We're going to use that units of activity method to find our depreciation expense for 2019, assuming that machine usage, our actual usage in 2019, was 1,800 hours. Then our last piece is the declining balance method. We're going to use the declining balance method using double the straight line rate for 2019 and 2020. Are there any questions so far? Okay. Let's talk about straight line. So it's going to be called straight line because it's constant throughout the life of this asset. So we have the information on the screen over to the left that we were given in the problem. Here on the right is the formula to figure out our annual depreciation expense. So the first piece is cost minus salvage value. So that's going to give us what we call the depreciable cost. So we take a look at the information that was given to us. We said that the cost was $150,000. Salvage value was $12,000. So we plug that in. We can see that our depreciable cost was $138,000. So that's our first step here for straight line. It's just taking our cost minus our salvage. Then you'll see that we have in the next line, depreciable cost divided by its life in years gives us what we call the annual depreciation expense. We're talking about the annual depreciation expense here. So we can figure out our annual depreciation expense by taking that depreciable cost that we solve for and dividing it by our life in years. So our life in years, we were told, was this 5-year life. Right? So we plug those numbers in. We take our 138 divided by our 5, and that's going to give us our annual depreciation expense of $27,600. Now, this is where knowing when we purchased the machine would come into play. If we purchased this machine on December 1st of 2019, and we wanted to figure out the depreciation expense for 2019, it wouldn't be $27,600 because we would have only had it for 1 month. So we would have had to take that annual depreciation expense that we just solved for and multiply it by 1/12. But here, we purchased it at the very beginning of the year. So 2019's depreciation is going to be our $27,600, and you can see that 2020 is exactly the same. Because, like I said at the start of this example, it's called straight line depreciation because it's constant throughout the life of that asset. So if I asked you for 2021's depreciation, it would also be 27,600. Now if we move on to the units of activity method, it's a little bit different, but we're going to start off the same way. We start off once again with cost minus salvage value to get our depreciable cost. All right, so we've already solved for that one. We take the cost of 150 minus our 12,000 salvage value to get our depreciable cost of 138. Now you'll notice the next line talks about how we solve for the depreciable cost per hour. So we're not finding our depreciation expense up next. Right now we're trying to figure out depreciable cost per hour. So we do that by taking the depreciable cost that we just solved for, that 138,000, and divide it by the life in hours. Right? So like we were talking about, the life was given to us in two different forms: working hours and years. We cared about the number of years when we were dealing with straight line. We care about the number of hours when we're dealing with the units of activity method. So we'll take our 138,000 divided by the 10,000 working hours to find a depreciable cost per hour of $13.80. What that means is that for every single hour that this machine is running, it's going to depreciate by $13.80. Right? So the next step is going to be to take that $13.80 per hour and multiply it by our actual usage. Multiply it by the 1,800 hours that we actually ran this machine. So when we take that $13.80 times our actual usage of 1,800, we can see that our depreciation expense is $24,840. Now, let's go back and talk about if we had purchased this on December 1st. If we had purchased this on December 1st, we would not multiply that 24,000 by 1 over 12. We only do that under the straight line and the declining balance method. Under units of activity, if we bought this machine on December 1st rather than January 1st, we would just expect that the actual amount of usage would be less. So you don't need to worry about when you purchased your asset under the units of activity method. We just care about cost, salvage, life in the units, which could be hours, which could be miles, right? And then our actual usage, which in this case was the 1,800. Those are the pieces that you need to focus in on whenever we're doing the units of activity method. So are there any questions so far? So let's talk about the declining balance method. So your declining balance method is very different from straight line and units of activity, right? And this one can sometimes be a little bit tricky, especially based on how it's worded in your textbook. So let's just take a look at the formula that we have on our screen right now. So first we take cost minus accumulated depreciation. And that's going to give us something called the book value. So that's step one. And you'll notice that that's different than what we did in step one of the previous two methods. Right here, we don't take cost minus salvage. Here we take cost minus accumulated depreciation. Then once we find that book value, we multiply it by 2 over the life in years. So in your textbook, that's described to you as double the straight line rate, because the straight line rate is 1 over the number of life, or number of years in its life. So here, to use double the straight line rate, we just toss a 2 up in the numerator. Then, when we multiply those out, we solve for our depreciation expense. So if we take a look at 2019, and we need to figure out cost minus accumulated depreciation first. Well, cost, it's still that 150. That part doesn't change, right? So we can start there in our book value equation. So $150,000 is our cost. Our accumulated depreciation in this first year is going to be 0. And that's because we just purchased this machine. So there has not been any accumulated depreciation so far. So for year 1, under the declining balance method, your book value is going to be your cost here. Then we can take a look at the next step, right? When we take our book value times 2 over the life in years. Well, our life in years, we were given in our problem as a 5-year life. So we'll take 150,000 as our book value times 2 over 5, or 40%. And when we multiply that out, we get $60,000. So that would be the depreciation for the full year of 2019. Now, if you purchase this machine on December 1st, 2019, you would take that 60,000 times 1 over 12, because you only had it for that 1 month. Right? So once again here, under the declining balance method, we care about when we purchased that machine, because we need to know how long we've had it for, to know how long we need to depreciate it for. So that's our depreciation there in 2019. Now, if we take a look at 2020, the setup is going to be the same. Our numbers are going to be slightly different. So for 2020, we have some accumulated depreciation. It's depreciated $60,000 so far. So we take 150 as our cost, minus that accumulated depreciation, to find our new book value of $90,000. Then we bring that book value into the next step of this formula. 90,000 times 2 over 5, right? That 2 over 5 remains the same no matter what year you're doing this depreciation in this problem. We don't have to cut away years as we move on. It's what is the full life in years for this asset. So 90,000 times 2 over 5 gets us a depreciation expense of 36,000. So we'll toss that in as our 2020 depreciation. Now, if we had to work on 2021's depreciation, we now have $96,000 worth of accumulated depreciation, right? Accumulated depreciation is the built up depreciation over time. So we would take 150 minus 96,000 to find our new book value. So you'll notice that your declining balance method, you depreciated heavily at the start, right? 60,000 compared to, I think it was like 27,000 something under the straight line method, right? So a company might want to depreciate something heavily at the start, get that non-cash expense in there to maybe lower some tax burdens on them, right? So if a company is able to depreciate this machine 60,000 in its first year, that could be helpful for them in their financial setup. So are there any questions whatsoever about depreciation?
I had a question on the declining balance depreciation method.
Okay.
I can't remember if like what homework example or if it was like somewhere in the notes, but like for future reference, like say on the exam, will it say if we're using double the straight line or straight line rate? Because I have somewhere in just like as straight line rate, it's 1 over the useful life years, but double the rate is 2 over the useful years. Like, will it state which one we're going to be using, or are we automatically assuming that it's always going to be double the straight line?
If you are using the declining balance method, it's always going to be double the straight line rate.
Okay.
Yeah, the straight line method is when you just use the regular straight line rate, the 1/5 in this case. Any other questions? All right. Well, let's talk about division of net income. So this is what part of chapter 12 touches on, right? And so we have these partnerships popping up now. And these partners need to figure out how they're going to divide up their net income. So in this example problem, we're told that McGill and Smith have capital balances on January 1st of 50,000 and 40,000 respectively. The partnership income sharing agreement provides for annual salaries of $22,000 for McGill and $13,000 for Smith, interest at 10% on beginning capital balances, and remaining income or loss to be shared 60% by McGill and 40% by Smith. We then need to prepare a schedule or a table, right, showing the distribution of net income, assuming that our net income is first 50,000, and then we'll do an example for if it's $36,000. So we're going to set up this schedule here. So let's just look at what's up at the top. We have our two owners and then a total column, right? So we'll write those up at the top of our table. And then over on the left side, we have the salary, the annual salary that we were told that each of our owners get, our interest on the beginning capital, and then we have total salaries and interest, where we just add up our salary and our interest amounts. Then we have our remaining income portion that we'll add or subtract to then find our division of net income. So this is going to be the setup that you're going to be using for your division of net income for a partnership, right? Is we just write the salary, interest, total salaries and interest, remaining income, and division of net income. Those are the pieces that you'll need to know. So let's start filling this in. So the first piece is salary. So we were told that McGill receives $22,000 in a salary. We were told that Smith receives $13,000 in salaries. And then we add those salaries together to get our 35,000 over there in our total. Then we're told that the interest is 10% on the beginning capital balances. So we need to take a look up at the very beginning of our problem where it says McGill and Smith have capital balances on January 1st of 50,000 and 40,000 respectively. So for McGill, we take 50,000 times 10% to get that 5,000. For Smith, we take the 40,000 times 10% to get our 4,000. And then we add together the 5 and 4 to get our 9,000 over there in the total section. So far we're just working through the partnership income sharing agreement and filling in the information here in this table. Our next line is total salaries and interest. All we're doing is adding down, right? So 22,000 plus 5,000 for McGill to get 27,000. Smith, 13,000 plus 4,000 to get 17,000. And then our total column, we could take 35,000 plus 9,000 to get 44, or we could also add a cross where we do 27 plus 17. Either way, you'll get 44,000 in that total spot. Now that 44,000 is a pretty important number here, because to figure out our remaining income, we need to take that 44,000 and compare it to the net income that we made. So in this first part, we're going to assume a net income of $50,000. So we have a net income of $50,000. We are supposed to pay out $44,000 in salaries and interest to our two owners. So that tells us that we have $6,000 left after salaries and interest, right? We take that net income and we subtract out that $44,000. So we have an extra $6,000 to play with here. So we can put that $6,000 in the total column for remaining income. Now we take a look at what the income sharing agreement tells us to do with this remaining income. It tells us that it's to be shared 60% by McGill and 40% by Smith. So we need to take that 6,000 times 60%, or 0.60, and we see that McGill is supposed to get $3,600. So we can toss that under the McGill column. Smith is supposed to get 40%. So we take that 6,000 and we multiply it by 40%, or 0.40, and we see that Smith is supposed to receive $2,400. Now, just to make sure that we did our math correctly, we can add a cross on this remaining income row and say that 3,600 plus 2,400 should equal 6,000. So that's just extra piece of net income that each of these owners get, right? Because they made more than what their salaries and interest were supposed to give them. So McGill's getting an extra 3,600. Smith is getting an extra 2,400. So now for your division of net income, we once again just add down, where McGill, salaries and interest were supposed to be 27,000, gets that extra 3,600. We add those two together, and we see that McGill receives 30,600. Now Smith, total salaries and interest were 17,000, gets the extra 2,400. So Smith gets 19,400. And then our total, we can either add the 44,000 plus the 6,000, or we can add a cross on that bottom line. Either way, we'll end up with 50,000. And you'll notice that our grand total there of 50,000 is our net income. Because what we're doing here is we are splitting up that 50,000 between our two owners. So your division of net income will always add up to the total net income amount. Any questions about how we did any of that before we move on to the second part? All right, let's say they didn't have as successful of a month. And instead of making 50,000, they've only made 36,000. What do we need to do? Well, we make another one of these tables. And it's going to be set up pretty similarly. You'll notice one change. Instead of remaining income, we're going to have what's called a remaining deficiency. And we'll talk about what that means when we get to that point in this example. So McGill and Smith, their income sharing agreement has not changed here just because of the net income amount. So their salaries are exactly the same. McGill is still supposed to get $22,000 as a salary. Smith is still supposed to get $13,000 as a salary. And when you add those two together, you still get that $35,000. So that line looks exactly the same as the last part when we had a net income of $50,000, right? Now, interest still remains the same as well. It's still 10% on the beginning capital. So McGill gets $5,000 because that's 10% of McGill's beginning capital balance of $50,000. Smith started off with $40,000 in their capital balance. So you take 10% of that, you get the $4,000. And $5,000 and $4,000 still add up to $9,000. So far, nothing has changed. Total salaries and interest, we're still just adding down. 22,000 plus 5,000 and 13,000 plus 4,000. So these first three lines are exactly the same no matter what the net income is. Because those pieces, salaries and interest, were set amounts. They agreed upon a certain amount of salary and a certain amount of interest. This last piece, this remaining income or deficiency, is dependent on what's left over, right? So this is the part that's going to change. So in the last example, we took 50,000 minus 44,000, and we saw that we had an extra 6,000 to split up between our two owners. Here, we notice that we're supposed to pay out our owners $44,000 in salaries and interest, but we only made $36,000. So we don't have enough to give them all of their salaries and interest that they're supposed to be receiving. So we'll take that $36,000 net income, subtract out our total salaries and interest, and we see that we now have a deficiency of $8,000. So instead of giving McGill and Smith even extra money on top of their salaries and interest, what we're going to have to do here is we're going to have to take away some money from their salaries and interest because we didn't make enough during this time. Now, the 60% and 40%, how it's supposed to be shared by McGill and Smith is still the same, even though this is a deficiency. So we take that 8,000 and we multiply it by 60%. And we see that McGill is going to have $4,800 taken away from their salaries and interest. Smith, we take the 8,000 times 40%. We see that 3,200 is supposed to be taken away from Smith. So in the last example, it looked great to be McGill, right? Because McGill got more added on because McGill gets 60%. Here, they're getting more taken away from them, right? So they might have more money in the business. They might do more from like a day-to-day operation standpoint, right? So they get this 60% split. And when there's extra money to be handed out, that looks great. And then in this case, when there's a deficiency, it's not so great, right? Because more money is being taken away now. So to figure out our division of net income, what we're going to do is we're going to take our 27,000 for McGill, subtract out 4,800. We see that McGill will get 22,200. Smith, you start with the 17,000, take away 3,200, and Smith gets 13,800. You add those two numbers together, and we once again see our net income there in the total column for division of net income. Now, an important thing to remember here, just because McGill and Smith had some taken away in that remaining deficiency row, that doesn't mean they're actually losing money here. The company still made $36,000. McGill's capital balance is going to be increasing by 22,200. Smith's capital balance is going to be increasing by 13,800. It's just not going to be increasing by as much as it did when they had a higher net income. Right, so they're still making money. They're still seeing their capital balances increase, even though there is a deficiency in this example.